My name is Jake, welcome to the channel. In today's video, we're going to do a Review My Pie video where I review subscriber portfolios. This is one of my favorite series on the channel. I do these videos every 3 weeks. The rest of the videos on my channel, I just talk about different topics around dividend growth investing. If you're new to the channel, once again, my name is Jake. I retired here at the age of 37 from my 9-to-5 job. So I'm no longer working my 9-to-5. I'm actually living off of my dividend portfolio. And this is really cool because when I first started creating content on YouTube, it was entirely different. I was in a complete different phase of my life where I was working, I was hustling, I was investing into real estate, I was creating YouTube videos, working literally 7 days a week. And now it's a lot more relaxed and, it's kind of interesting. I think back on, how crazy and hectic my life used to be compared to now. Sometimes I kind of miss the hustle, but other times when it's really, really cold outside and dark at 5 p.m., I'm just like, man, what was it like driving home at 5 o'clock and it was pitch black? Oh, well, I guess I don't have to worry about that anymore. I reached barista fire here this year, so I am actually living off of the income from my portfolio, though money is still a little bit tight because if you know my story, I was laid off in the earlier part of this year, and so it kind of took us by surprise. I was actually intending on working another year and a half, but, I worked in software sales and there's a massive recession when it comes to my industry, or at least where I was working. And the money that I was making, the opportunities that I had last year, they're no longer there. I mean, if I wanted to go back and do what I was doing, I'd have to work part-time in an office. We'd be in Austin right now in Texas, and that's completely different than what we're doing right now. So that's kind of a long-winded intro to who I am. If you're new to the channel, if you've been subscriber for a while, I try to keep it real and share the good, the bad, the ugly, and not sugarcoat what it's really like to pursue a life where you're living off of your dividend portfolio. So in today's Review My Pie, we're going to answer a question that I got here on one of my videos. Then we're going to take a look at 3 portfolios. The first is going to be from a 35-year-old here in the US. The second, a 22-year-old from here in the US. And then the third, a 33-year-old from Canada. And as always, everybody, the timestamps will be in the description below, as well as the portfolio links. If they're there, they will be in the description below. And as always, everybody, I'm not a financial advisor, so please don't take what I'm saying as financial advice. This is just merely for your entertainment. And as always, everybody, I don't review the portfolios in advance, so I'm viewing them in real time. And I don't have this scripted or anything like that. It's all raw and unfiltered and all that good stuff so that it can be as authentic as I can possibly make it. But here really quick before we dive into the video, I can pay my water bill and so I can't actually afford to live this barista life. I couldn't do it without you all. I wanted to share this. If you are interested in signing up to Seeking Alpha Premium, I'll leave a link in the description below. You'll get 33% off. This is a promotion that they're doing until December 5th. On December 6th, this promotion is gone. You have until December 5th, this promotion, and what you'll get is you'll get Seeking Alpha Premium for a year for $167. You get a free trial, all of that good stuff. This is just Seeking Alpha Premium. And also, if you are interested in Seeking Alpha Premium and Alpha Picks, this is something that's interesting if you're more into, timing when and what you buy. You'll get curated lists and stocks that will be sent to you through Seeking Alpha. So it's kind of an interesting thing. It's not going to be for everybody. You'll get both of them. This is, I believe it's 45% off. But if you use my link, and like I said earlier, I do get a kickback. I do get a commission if you use my link. So I greatly appreciate it. But as always, no pressure. And I know we're getting around the holiday season where people are, just generally spending more money. So it's something to consider. And I kind of draw the correlation with dividend stocks. You generally pay a premium for quality, and it can be difficult to buy great dividend stocks at a good valuation. Have you ever ran into that where you're looking at dividend companies and you're like, oh man, they're just too expensive? Buying dividend stocks when they're on sale, it's kind of like going shopping on Black Friday, and it kind of looks a little like this.
Happy holidays, Rick. And to you, my friend.
Oh my gosh, I love it. I love it. Oh man, true story. When I was, how old was I? I was like 21 or something. I worked at Circuit City. For those of you that are old enough to remember, it's kind of like a Best Buy. I remember working Black Friday at Circuit City, and yeah, it looked exactly like that. So yeah, that was fun. Brings back some good memories. Well, anyways, let's take a look at this first question here that I got on one of my videos. And I think it's pretty interesting, and I think it's pretty relevant, especially for those of you that are maybe new to investing or a little bit younger or have a longer time horizon and want to simplify some things. So the question is with how SHD, DGRO, and DGRW have been performing based on 2022 and 2023, if you were starting today, would you still do 40-40-20 in SHD, DGRO, and DGRW for the next 10 to 20 year time horizon? So I like this question for a couple of reasons. You're asking the right thing because when you're first starting out, you want to hopefully avoid all those pitfalls that come along with doing something new, right? When you're doing something that you've never done before, there's a lot of learning by doing. And I remember and I recall back when I first started learning about dividend investing, I made a lot of mistakes. I tried to over-engineer things where they didn't need to be over-engineered. I tried to have the perfect ratio between growth and, the sector allocation and everything. And it was just, at the end of the day, too complicated. And I realized that there's got to be an easier way. And then when I discovered J.L. Collins and The Simple Path to Wealth, it really, I had that light bulb moment where it's like, okay, there's a lot of great options out there, but you don't have to pick everything. And sometimes the simple path is the right path for most people. Okay. And when I realized that making it more complicated doesn't necessarily make it better, that's really when my perception changed around how to view this. And so if I were to start today and start over, I would 100% follow what I've been talking about when it comes to the core and satellite approach to investing and the simple path to wealth. Okay. And if you're new to my channel, you've never heard that before, I think that video will open your eyes to a lot of what I'm going to be talking about here and what I talk about on my channel. Just for reference, at the end of this video, I will have that video that I'm talking about pop up at the end and you can watch that video next. But essentially what it is you're setting up your portfolio in a core and a satellite approach where your core portfolio makes up, high quality, low fee index funds, and your satellite positions are smaller positions that are focused on your investment goals to help kind of balance things out. And so if I were starting over today and I had a 10 to 20 year time horizon, I 100% would simplify it in a similar way like this, where SHD and DGRO make up the core of my portfolio, and I build upon that foundation. And the thing that I love the most about this is it's not set in stone, right? It's flexible based off of what your investment goals are. But if you use this strategy, kind of, the core and satellite and the simple path to wealth, if you use that as a North Star guiding you towards what you're trying to achieve, I think it'll make things a lot easier. And here's the one thing, I've gotten a couple emails and comments around this in the past. This process, this approach that I'm describing, if it's complicated, you're not understanding me. This approach that I'm suggesting it really provides you with flexibility. It's not set in stone where you have black and white, where you have to do it this way or another way. It's to help guide you in the direction that will help you meet your individual personal goals. So thank you so much for the question. I hope that helps. All right, let's take a look at the first question here from Brandon. He writes, "Hey Jake, first let me say thank you for the free information. I'm so glad I found your channel and it's really educated me on how to start, manage, and plan my retirement portfolios with dividends." Thank you, Brandon, for saying that. I'm currently 35 and plan to retire early-ish, maybe in my early 50s, if things go well, conservatively. Along the way, I'd love to buy land, build a home, and establish a self-sustaining homestead, farm, and live the country lifestyle. Oh man, I love that. I love it. I'm hoping that building my dividend portfolio over the next 20 years will be the ticket that helps me comfortably maintain that lifestyle later in life. I'm a big fan of the core. I did not plan this. I didn't know know he's going to write that. I'm a big fan of the core and satellite method you teach, and it's been my focus. I also like having a more concentrated portfolio so that I can easily manage my positions and potentially switch out of stocks over time if I need to. I have a time horizon of at least 20 years. I'm focused on growing my core positions now and will reallocate later in life when it makes sense to pivot. I'd like you to take a look at my allocations to help me understand if they make sense from an exposure and diversity perspective. Although I'm growth leaning, I'm very big on safety and want to limit drawdowns as well. Thanks for all you do for everyone. Well, Brandon, thank you so much, man. I really appreciate you saying that. A couple of things, the homestead idea, man, back in 2020, my wife and I, we were so close to buying land out by Fredericksburg in Texas. It's about an hour and a half away from Austin. And I had spoke to the lender, went and saw the site, everything checked out. The problem is right then and there, a few months later, I actually ended up getting laid off from another job. Software has been quite the roller coaster. My entire team and I were laid off. It was not performance related at all. They entirely shifted the strategy and the entire team was laid off. And it sucked. But anyways, I'm glad that I didn't buy it because that would have been very horrible, the situation that we were in. But I hear where you're coming from, and that excitement reading this, it just sparks back memories of myself when I was thinking about that as well. It's still kind of on the, in the back of our minds, but we'll have to see. Anyways, when you say here that you want to focus on your exposure and your, diversification, it sounds like you're very, very risk averse. And that's a good thing. And 20 years is a long time. You want to make sure that over a long, time horizon like this, that you're getting growth. And I like to call it a conservative growth. And it sounds like you're the type of person that would benefit from probably, truly an ETF-based portfolio where the overwhelming majority of your portfolio is really in ETFs. And regardless if they go up or down, you're still invested and you're still reinvesting. And that's what I would recommend for someone like you based off of what you said here in your email. All right, let's take a look at your portfolio. So you got 10 holdings, you got a good, decent dividend yield, you're beating the S&P 500, you have a low expense ratio. Let's see what you have in your dividend portfolio. So you got VTI, SHD, and DGRO. This makes up 80%. You do absolutely follow my channel. So I like that. So you got 30, 29, 20, and then you got Microsoft, Apple, Texas Instruments, Pepsi, AbbVie, Abbott, okay, and then A.O. Smith. Okay, great. So these are all really, really great companies. You're going to definitely get some overlap with DGRO and these two right here. So by having so much in DGRO, you're actually getting a lot of overlap with Microsoft and Apple and with VTI. So just bear that in mind. You're definitely going to get a lot of Microsoft anyways. What you may want to consider is, because you talked about rebalancing, what you may want to consider is adding a growth ETF in here, one that you're going to sell in the future to then rebalance. Because you mentioned that rebalancing, right? Why not consider maybe lowering your individual positions here or something in between, and then considering a growth ETF. I personally like VGT. It's one of my largest holdings in my Roth IRA, for example, and my son's account that we have for him. VGT is one of his largest positions. And so it's one for me that I'm going to flip and sell in the future. So it's maybe something to consider where you're getting a ton of exposure into Microsoft and Apple with VGT or VUG or something in between. And you could add an ETF like that to this portfolio, maybe at 5 or 10%, or in another portfolio that you have designated as a growth portfolio, so you keep them separate. That's a way that you can invest for growth without the emotions. Like, for example, when VGT tanked like 35% last year, I was so excited and so greedy, I tried to buy as much as I could. And now it's up like 45% this year. Like, you're going to get that roller coaster, but I'm much more comfortable going aggressive in a growth ETF versus going aggressive in individual stocks, simply because I've been burned way too many times. And it's just the nature of the game. And I really like index funds for that reason, because you don't have to pick the winners. You just pick the index. Okay. And so that's something to consider. Otherwise, I really, really like your strategy. A portfolio like this, once you have it set up, you don't reevaluate and question your strategy every week, every month. Once you have this set up, this is something that you review on a yearly basis. Okay, very, very important. This isn't something that you open up your app every day and look at it 2 or 3 times a day. This is a set it and forget it. You automate your investments, you automate your contributions or your transfers into this portfolio, and then you go back to enjoying other areas of your life that you enjoy, and the investments are just working for you in the background. So, Brandon, I hope that this helps. I hope that this, kind of shed a little bit of light on how to kind of view this with the growth. In terms of the VTI, one last thing here, it's going to be difficult to live off of the dividend of VTI. So this is probably one that you're going to flip as well. So maybe you consider, how you can evaluate, what VTI would look like, combining it with a growth ETF like VGT as an example, and how that could fit into it. But other than that, I think this is great. I think you're off to an amazing start. I wish I would have started off like this 10 years ago. It would have been life-changing in terms of the stress that I would have avoided along the way, and the total returns would have been absolutely life-changing. But anyways, Brandon, thank you so much for sending over your portfolio. I hope that was helpful. All right, let's take a look at the next portfolio here from Jacob. He writes, "Hi, Jake. I love your videos and follow all of yours and JL Collins' tips to become a better investor following the simple path to wealth. I'm 22 and don't know when I plan on retiring yet, but most likely it will be in my 50s or 60s. I max out my Roth IRA each year with the Schwab. This is the Schwab Total Market Fund, and have a taxable account with M1 to grow and compound dividends, where I invest $150 into it bi-weekly. I hope to live off it one day. I'd love to hear what you think about my pie, if there are any suggestions that you might have." All right, well, Jacob, thank you so much for sending over the email. I think this is great. You're 22 years old. You're very young. You don't really know what's going to happen, over the next 20, 30, 40 years. And I'm glad that you acknowledge that. All of those big life events have not yet taken place. You're probably not married. You probably don't have kids just yet. All of those things change who you are. And if there's anything in life that I've learned, it's that you have no idea what's going to happen in life. If I've learned anything from Murphy's Law, anything that can go wrong most definitely will go wrong, and just expect the unexpected. But I think you're doing the right things by setting yourself up for success, taking advantage of tax advantage accounts like a Roth IRA. You're automating your investing. You have a great foundation. All right, let's take a look at your portfolio. You got 28 holdings. You got a really good dividend for your time horizon. I really like this. And this is in your taxable account, right? In your Roth IRA, you had the total US stock market ETF or index fund. And then you had you have a very low expense ratio. You got the core and satellite. I love this, man. I love seeing people actually take what I say in my videos and implement it in practice. I think this is so cool. I didn't know, like I said at the beginning of the video, I don't look at the portfolios before. I had no idea that you did this. I think this is absolutely incredible. It puts a huge smile on my face seeing that people actually listen and, are following to some degree what I'm saying. Whether that be the right thing or wrong thing, you'll have to decide that. But I think this is so cool. So let's take, in your core portfolio, you have VTI and VXUS. Okay, this is interesting. This is a different take than what I suggest, but let's take a look at it. Let's dissect it a little bit. So you got VTI and you got VXUS. Now let me ask you a simple question. So Jacob, in 20, 30, 40 years, what is your plan with this? Are you going to live off the dividend? Are you a dividend investor? Like, is that your plan? Or are you planning on selling this and then rebalancing into something else? Because the way that you want to think about this, you want to think about, are you planning to flip this and rebalance into something else? Or are you planning to buy and hold forever? Because I'll say these two ETFs, these are great. I have VXUS in my Roth. I have VTI in my Roth IRA, though this is your taxable. So for me, it's a clear flip. I'm going to purchase these to get broad exposure at a low expense to the total US stock market and international, and I'm going to sell it and rebalance it. So a portfolio allocation like this, it really depends on what your goal and strategy is, okay? Because these are great if you want global international exposure at a low fee, it's going to be very difficult to live off of the dividend on VTI and VXUS. Okay, so this is why investing can be so difficult. Yes, these are great ETFs, but what's the goal? What are you going to use these for, right? I'd say this all the time, whether you like it or not, it's like a vehicle. These investments are vehicles to get you to a destination. If you're not sure of your destination, it's difficult to pick the vehicle. So just understand that these ETFs, you're probably not going to live off of the dividend. That's not what these are designed for. These are not designed for you to live off of the dividend income unless you're a multi-millionaire. Okay, so just keep that in mind when you're thinking about VTI and VXUS. Okay, now let's take a look at your satellite position. I do like that you have 20% in your satellite. I think that's a good number because your core is where the majority of your money is going to go, right? And so when we look at this, you got the most in technology, consumer goods, financials, materials. Okay. In technology, you have Sony, Microsoft, Apple, VGT, and the SMH. Okay. When it comes to the satellite positions are very personal to the individual. And it could make sense or it could make no sense. And that's what I love about the core and satellite is the core, you want to make sure that you're getting that right. The satellite, you do what you want with it for the most part, right? Like some people have crypto in there, some people have gold, some people view other things as their satellite positions, like, commodities or basketball cards, for example. It is what it is. I'm not going to be as really judgmental about this. I think that there's ways that you could optimize this, but if this is how you, the thing about the satellite positions as well is it's also more of the emotional side, right? Where it keeps you invested because you're emotionally invested. And you probably like PS5, like PlayStation. You're probably like my wife. My wife plays PlayStation every day. Microsoft and Apple, like this is more of an emotional pie. And I think, I can see that. And, that's fine. That's absolutely fine in my opinion. Like there's things that you could do to optimize it, but I'm not going to say anything for or against it really, because this is individual to you. And I'd say go to town. I think that's great. Whether you have 25% or 10% in Microsoft or Sony, that's entirely up to you. This, in my opinion, is not about having it perfect. It's a matter of what's going to be perfect for you, the individual. All right, now let's take a look at consumer goods. You got Louis Vuitton, okay. ASO, Costco, Lowe's, Home Depot, and Hershey's. Okay, I like the allocation that it's not, all in just in one individual company. I like that you have it spread out. Like I said a little bit earlier, this is more of the emotional side when it comes to investing. These are more companies that you probably are a consumer of, that you're a personal fan of. And I say that's absolutely fine. What's really cool is I'm so curious to see how Hershey's is going to react and respond to all the influencer attacks that they're getting, right? You got a lot of influencers online that are growing a fan base that are, coming to market with their own individual products. Mr. Beast comes to mind, when I think about that. Love him or hate him, I don't have any opinion on him, but the KSIs in the UK, and you got Logan Paul with Prime, it's just an interesting use case of how influencers are penetrating the consumer market. And this was not the case 5-10 years ago, not at this scale. So I'm curious to see how Hershey's, a conglomerate in the space, is going to respond. Are they going to go and aggressively acquire these new companies, or are they just going to kind of dwindle away, right? So I'm really curious. I whenever I see Hershey's, I can't help but think of that. And I think it's so cool. And another thing is, another reason, Hershey's has been around for over 100 years, right? It's an amazing company, amazing brand, but I'm curious to see how they're going to respond to this changing environment. And that is one reason why I'm not the biggest fan of having so many individual stocks at more than 5%, because you just don't know what's going to happen 5, 10, 15, 20 years from now, especially if your goal is to generate generational wealth. That's why I love more so investing into index funds high quality index funds, and then the satellite positions are a little bit more on the emotional side. They're not necessarily as much going to move the needle because you have your core. But anyways, that's kind of a random thought, and yeah, I thought that was interesting. All right, next let's take a look at healthcare. What do you got in here? You got a medical device ETF like that, ELV, UNH, TMO, VHT. Okay, I've actually not really looked into this ETF. What's the expense ratio? Okay. A little bit higher than I would have expected, I guess, compared to this one that has only, VHT is one that I'm more familiar with. Interesting. So yeah, I think this is fine. I'm not going to really go deep dive into each individual company. I do like that you have ETFs in here as part of your satellite positions in these sectors. I think that that's fine. Next, let's take a look at financials. You got growth in here with Visa, MasterCard, SPGI, and you got Chubb. Interesting. Okay, I do like this. The only thing so this is one thing. I really like Chubb, but because this is a company out of Switzerland, if I'm not mistaken, does it show in here where they're from? Yep, Switzerland, Zurich, beautiful country and beautiful city. I've been to Zurich many times when I was living and working in Munich. Oh, it's a beautiful city, Zurich. Anyways, I like Chubb, the insurance company. What I don't like is paying a 35% international tax to Switzerland. And that's why I personally much prefer investing into US-based insurance companies, because you don't have that 35% international tax that you have to pay to Switzerland. So that's something to definitely consider. That's another reason why I don't invest into Nestle, where I would much prefer to invest into Hershey's. Because of the international tax. So it's very, very important that you're considering that if you're a U.S. citizen or resident here and you pay U.S. taxes, you want to make sure and understand that you're going to have a tax. For example, you got the Sony in there. Sony, I think you pay the ADR fee as well that comes with that. So there's just things to definitely consider when you're investing in international companies. All right, let's take a look at railroads. You got Union Pacific and you got Canadian Pacific. I think these are two of the best railroads out there. I think these are great. I personally own Union Pacific. I think it's a great dividend growth stock. All right, let's take a look at the next one. Industrials. You got Waste Management and you got Deere. Both really, really great companies. I like that you have it at 50-50. Both really, really, really great companies. All right, let's take a look at the last ones here. You got in materials, you got ADM, okay, and you got Corteva, CTVA. I'm actually not familiar with this one, so I can't really speak too much to it. I do like that you have it, pretty equally weighted. I couldn't really tell you much about this company. I guess maybe you work in this industry where you're familiar with this company. But for me personally, it's hard to invest into material companies that I don't personally understand as a consumer, or understand it in some way. Like, it's really hard for me to analyze material stocks or even healthcare stocks just off of their balance sheet, their income statement, their cash flow statement of cash flows. Like, to look at it on paper, it's hard for me to really understand these businesses if I don't really have any industry specific knowledge. And that's why it's really hard for me to invest in the individual companies in this sector. And it's something to definitely consider, because when you're in a bear market and when you see there's a drawdown of 20, 30, 40%, it's hard to stick with a company that you don't really understand. So make sure that you're understanding what these companies are and what they do, how they generate their revenue. So with that, Jacob, thank you so much for sending over your portfolio. I hope that was helpful. All right, the last portfolio here is from Dave. Dave writes, "Hi Jake, first off, congratulations on the health and happiness of your family. Truly a blessing." Thank you so much, Dave. I appreciate you saying that. As a fellow YouTuber, somewhat new, I was hoping you could review my portfolio, as I believe it may provide value to yourself and to your viewers. Also been a fan of yours for a while. Well, Dave, thank you so much, man. I'll start with some information about myself and then go from here. So I'm married to a beautiful wife. We currently have no children, but plan to in the near future. I'm a CPA and live in Canada, and I'm 33 years old. I've attached an Excel file of a portfolio I converted the CAD to USD for the reviewing ease. The Excel file contains various information regarding my holdings. The portfolio is in a tax-advantaged account, which is similar to the Roth IRA, and foreign dividends are taxed at 15%. The reason for not holding my foreign equities in a similar to a 401k is because I currently have a company match in which some assets are invested in U.S. equities already, and these accounts are essentially maxed each year. These accounts are mostly invested in Canadian banks, Canadian energy, and U.S. companies. The portfolio I've sent you is currently invested in dividend growth companies with a history of increasing cash flows and returns for shareholders. I keep a little cash in the account for select opportunities in the market as I see fit. I hold no ETFs as I enjoy analyzing companies, reading their financial reports, and investing as I see fit. FYI, some holdings will be more than 5% as I have a strong conviction in these companies. It's funny you put the disclaimer there. You definitely have watched my videos around the 5% there. Other information about myself and assets: you own a home valued about $560K with a $400K mortgage. Real estate is expensive here. I've heard a lot about that. You earn a stable and growing income as mentioned above. Have a fully funded emergency account for about 4 months worth of expenses. Have other opportunities with excess my cash, about $50K to purchase private company shares in the company I currently work for. And my time horizon is 20 to 23 years. Any comments on a portfolio? Welcome. Keep up the great work and wishing your family all the best. Thanks to Dividend Investor. Well, Dave, thank you so much, man. I appreciate you taking the time to send me this email. I think it's an interesting thing here. So the majority of the viewers of my channel are generally a little bit newer, right? And so when I talk generally about investing, I try to be a little bit more conservative. I talk more about ETFs. However, there are a small section of viewers out there who likely probably fit more in the category of picking individual stocks and building a dividend portfolio on their own. I think the majority of people that fit into that basket, they're probably, spending hours and hours planning this, researching this, because it's an actual hobby of theirs. I mean, you even created a YouTube channel to talk about this, so it's obviously your passion. So majority of the people watching are probably not going to be able to relate to this, but I still think it's interesting to show the other side of what it's like to actually take the time and analyze everything from A to Z and to over-engineer it. And that's probably what we're going to see in your Excel file. I can only imagine all the different colors and graphs and sections. I'm curious to see what it looks like because I've been in your shoes. I've done the exact same thing. But other than that, I think this is great. You're taking advantage of your tax advantage accounts. You're understanding your market. I do really like Canadian banks. I like Canadian railroads. I like Canadian energy. I think there's a lot of great conservative companies in Canada. All right, let's take a look at your Excel sheet and see what you got here. So as I predicted here, you got lots of colors, lots of graphs and everything. I love it. So I think this is cool. Let's take a look at what you have in here. Let's try to analyze and see, at a glance what you have here. So you got a handful of companies, not too many. You got Apple, Microsoft, Visa, Amex, TD Bank, RBC, Manulife, so insurance, I believe, T. Rowe, Brookfield, JP Morgan, Bank of America, Home Depot, Lowe's, Costco, mostly US, CP, Union Pacific. We saw that in the last portfolio. Realty Income and VC Properties. Okay, so you got a basket of, Canadian, US companies, banks, real estate, railroads, financial, insurance. Okay, so what we can do is we can take a look at your largest holdings by what you have invested. You have the most invested in here to TD Bank, for example, and Microsoft and Apple. Okay. What's interesting though, even though you have the most invested in Apple, it's probably one of your lower percentages in terms of your annual income. And you can see that over here, that though you have, the most invested into Apple, Microsoft, although Microsoft is pretty high, interesting. Okay. And you got the most in TD Bank. Okay, I like the distribution in terms of where your income is coming. Because imagine, for example, you had the majority of your investments in one single company, like, for example, MPW, and they cut their dividend. And then all of a sudden you weren't making, $6,000 a year from MPW, but now you're making only $3,000 a year. And then imagine that you bought the dip over and over again, and then all of a sudden, they cut their dividend. So that was my experience. So that's why I've been burned way too many times. That's why, I'm pretty strict when it comes to the 5% in terms of allocation in your overall portfolio. I think this is great. It gives me flashbacks to when I was doing this myself, spending hours on the weekends, listening to AFI, Blink 182, Fall Out Boy, all that good stuff, just rocking out and putting these spreadsheets together. I got so much enjoyment out of it. But now, it's funny, fast forward a couple of years, I don't even hardly ever use those spreadsheets anymore, right? And so when I first started, I thought that I needed these spreadsheets and then they were cool. Now, my strategy back then was very different because I had a strategy similar to this, where I was mostly invested into individual companies. I quickly learned that that's not what I wanted. But if I would have stuck with that approach of mostly just investing into individual stocks, I probably would have kept doing this. And so something that you want to definitely keep on your radar is when you're evaluating these different companies, one of the struggles that I came to was finding that perfect sauce, that perfect mix between sector allocation, the dividend income that I was getting, and I would over obsess over trying to get it perfect. And you know what I noticed? I ended up changing my mind all the time. I'd have version 1, 1.1, 2.2, 3 points, like dozens and dozens of different versions of these spreadsheets because I always ended up changing my mind. Do you follow what I'm saying? I did this before just like you. And the reason why I stopped doing it was I couldn't stay consistent with it. Now, if you're able to stay consistent with it, kudos to you, man. I think that's absolutely great. And to all of you out there who are able to stay consistent with a strategy like this, kudos, right? That's great. You're better than me because I couldn't do it. What I learned was that by adding a few ETFs as an example, I didn't have to have the perfect allocation. I didn't have to have the perfect mix of sector allocation because I was already getting that with the ETFs. And that's what I learned, that, okay, there's a much easier way to go about this. And I would encourage you, Dave, to consider finding maybe a balance of where you can kind of take advantage of both worlds, where you're getting that diversification from maybe a high quality ETF while still getting the benefit of picking the individual stocks that you want to own. That's why I always talk about the core and satellite approach to investing, because it provides so much flexibility. I say to most people, the core should represent 70 or 80% of your overall portfolio. But maybe you are a little bit different. Maybe 20 or 30% would be enough for you, where 20 or 30% are ETFs. But what it does is it balances out your overall portfolio. And at least for me, it helped me sleep at night, not second guessing myself. Oh, do I need 1 or 2 more percent in industrials? Or, oh, shoot, am I going to miss out if I have 1% less into Costco versus Lowe's or Costco versus Apple? Like, it helps you streamline things so much more effectively and then focus on areas in your life that are really, really important. Because I want you to take a second and think about this. Close your eyes and think about, why are you doing this? What's the whole purpose of all these spreadsheets? Why are you spending so much time and energy on this? Close your eyes and think about it. And if the purpose is for you to just accumulate more, and that's it, well, okay, that's fine. But if your purpose is so that you can use this to then pay for your freedom, to pay for your living expenses, to pay so that you can live a life that you choose versus having to go to work every single day, okay? And so that's what I would encourage you to kind of think about. Why are you doing this? What's truly going to bring you happiness, and what's sustainable? What can you do for the long term? So and the thing is there's no right or wrong. You're going to get tons of people out there that are going to say, this is the one and only way to do it. Or no, this is the one and only way to do it. It's personal finance. It's called personal finance for a reason, because it's personal. It's individual to every individual. So Dave, thank you so much for sending over your portfolio. I think this is great to see how different people view this topic of dividend investing. And hopefully we all have the same goal, is to generate generational wealth for your family, and to hopefully replace your active income with passive income so that you can buy your freedom. Thanks, Dave, for sending over your portfolio. Thank you so much, everybody, for watching. I hope that the video was helpful. I hope that you learned something new. And once again, if you're new to this and you've never heard about the core and satellite approach to investing with the simple path to wealth with dividend investing, I'll have a video pop up here in a second and you can watch that video next. Thanks for watching, and I'll see everybody in next week's video.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.